Hello, everyone. I'm Carrie Delgott, Wescott's Chief Operating Officer, and I'm here with Mark McCarron, our Chief Investment Officer. Great to see you, Mark.
Good to see you, Carrie.
Mark, this is our first webinar together in 2022, and the year's off to an interesting start. As we look back at 2021, the U.S. economy grew at its strongest pace in nearly 4 decades, with the U.S. stock market hitting several record highs. And that being said, the last few years have been dominated by a narrow market, tech stocks most notably. As we move into 2022, we've seen significant volatility as investors adjust to expectations of higher inflation rates and interest rates. As I've heard you share, portfolio diversification will be key in this market environment. So I do want to make sure we spend some time on that topic today. But with that brief overview, let me turn it over to you to jump into some of the details of what we're hearing from the Fed.
Yeah, that's the right question to ask, because we titled this slide, "Don't Fight the Fed." It's a common phrase. And they had their meeting in January, and they officially came out and said, with inflation above 2% and a very strong labor market, they sort of said, okay, it soon will be appropriate to raise target range for the Fed funds rate. They haven't changed any rates yet. They reiterated their 0% to 0.25% Fed funds, rate today, but they said, we're almost there. We're getting ready. And that's all it took to raise the volatility in the market and to get investors concerned. And why is that? It's really all about inflation. That inflation well above 2% comment. When you look back over last year, the demand for goods, the supply disruptions, all of that forced inflation to get to nearly 7% year over year. Now that's a very big number, very high relative to history. And in our view, and I think in the Fed's view, it's short term, and we'll cover that a little bit later. But the idea here is that progress on vaccinations, which is something that the Fed Chairman Jerome Powell focused on, and an easing of those supply constraints that we saw last year, that should continue to help the economy grow, help the employment situation getting better, more people back to work. And actually, he highlighted a reduction in inflation. Not today, not tomorrow, but longer term. And I think those are good things. That's a good news story. The market got a little nervous with the first statement. In fact, we can see how nervous it got by looking at the performance of the markets across January. So first of all, pretty much across the board, bond markets, which is represented here by the gray bar, as well as different segments of the stock market, all were down to varying degrees in January. We're not all used to this. It's been a straight up market for the last couple of years. And bond yields were rising, inflation expectations were rising, concerns about interest rate increases down the road. That's all it took to push the markets, in particular growth stocks, which are very sensitive, most sensitive to the long-term changes in interest rates, because they're valued based on a discount rate. And when that goes up, values come down. And you can see in this chart that small company growth and large company growth were the leading decliners for January. You mentioned that the market has been really dominated by the tech stocks the last couple of years. Well, those are the very stocks that led the declines in January. So is this a shift? We'll see. In fact, if you look at the non-US markets in green, they were down, but not down as much as the US. The US market, as represented by the S&P 500, finished the month of January down 5%, but did fall much further than that, almost 10% in January. So we're talking before it recovered. And so we're talking about this environment as a market correction. And corrections are a natural part of what happens in market cycles.
And let's stay on that topic for a second. I see it as the title of your slide here. I'm hearing market correction used to describe the volatility we've experienced over the last month or so, what is the official definition of a market correction?
Yeah, sounds scary, right? Market correction. So I think officially it's defined as a decline of 10% or more, or at least 10%, from the market's high to the current price. So basically a drop of 10%. That's all it is. And so you see that the US small cap growth segment of the market is still in correction territory. But it's not, a bear market. There's a very big difference between a correction, which is a price decline of 10%, and a bear market, which is often defined, yes, as much as a 20% decline in markets, but it also has to correspond with a decline in earnings, company earnings, corporate earnings, a decline in earnings growth that will cause effectively a recession, then leads to a bear market. This is not what we're talking about, right? This is a sell-off of the most expensive sectors of the market, down 10%. It's healthy. In fact, we cannot continue to rise at the pace we did last year. We highlighted this in prior conversations, but the market hit all-time highs again and again and again, and finished 2021, the third year in a row of double-digit returns. So what we're seeing is a healthy correction in the market. And during that time, just point out that Wescott portfolios are generally more diversified than the market that we're looking at here. They're globally allocated. They tend to be underweight the largest and the most expensive stocks, given the way we position portfolios. And so during a market correction, we're actually seeing the Wescott portfolios hold up nicely, better than the overall market, and diversifying that risk. And you highlighted before, we expect more of that to come in 2022 because that diversification has been ignored. The benefits of that diversification have been ignored the last couple of years as the strength of the technology market. In fact, if you take a look at the more concentrated nature of the market, in particular, there's a great example. The S&P 500, as we talked about, did fall into correction territory in January. And on the right-hand side, we're showing the components or the constituents of that S&P 500 index. And it's Apple, Microsoft, Amazon, Google, which is Alphabet here, Tesla, Facebook, which is now called Meta Platforms. All of these companies are down in absolute terms in January. Although many of them recovered the last couple of days, Apple, Microsoft in particular, based on that strong earnings. So when we talk about correction, we're talking about price declines, not earnings declines. In fact, Apple, Microsoft continue to generate very, very strong earnings. In fact, the top 10 names of the S&P still represent 30% of the index weight. You can see the weights that we have next to each position, 6.9% in Apple, 6.3% in Microsoft. It's such a widely quoted index. And 7 of the top 10 names are, I would consider, growth names, growth and technology names. I'll throw Tesla in there, Facebook in there, Microsoft and Apple, NVIDIA. All of these names are the ones that have been dominating the last couple of years. And you can see those are the ones that were down the most in January. In fact, 7 out of the top 10, I would characterize as growth or technology. And, names like Berkshire Hathaway and JP Morgan on the financial services side do represent some of the top 10 names in the S&P. And Berkshire Hathaway, for example, was the only one in the top 10 in positive territory. So the correction was sharp. It was quick. We're already seeing some recovery. But it's really important to note that this is the area of the market that's been down because of that concern over rising interest rates and rising inflation.
So is that concern a short-term issue or a more long-term issue?
That is a great point. That's what the market's trying to figure out. Is this a short-term problem or a long-term problem? The way we look at this is the way that investors or market participants look at it. And so what I've got here on this slide is a break-even inflation rate. So this is something quoted. You can see it in the markets. So what is it? Basically, it's a measure of expected inflation. And I've got a 5-year and a 10-year indicator here. The blue is the 10-year. The orange is the 5-year. And the latest value indicates that on a 10-year basis, market participants, investors, expect inflation to be 2.3%. That does not sound terrible to me. In fact, that sounds pretty normal. But it's much higher than what market participants felt like back in 2020, in the midst of the pandemic, where they felt like inflation would never go up. In fact, deflationary has been the word of the last decade, but a move in expectations from 0.5 to 2.3 is a very significant shift in sentiment, shift in expectations, and a short-term increase, clearly. But over the long run, we do not think inflation is a problem at this point. In fact, while it's going to be higher, things like mortgage rates and other borrowing rates, they're not going to be back to the 1980s. We're not going to go back to these very high inflationary times. And that's what this indicates to me, is that the long-term inflation expectations remain in check.
Good to hear. Good to hear. Why don't you close us out today with a summary of our 2022 outlook?
Yeah, I think this is an interesting year. We're coming off a very strong economy, a very strong market. We do expect markets to continue to open. So consumer spending, which has been focused on goods only, effectively, may be broadened out to services, taking those trips and travel and restaurants. Those are the things that will do better as the pandemic restrictions ease even further. That's a positive thing. That should help inflation pressures, right? It should ease them somewhat. But it's not going to be enough to stop the Fed from increasing their interest rate in March. They're going to start that. And that's what the market is trying to figure out, how significant it might be. They're going to start their interest rate hiking cycle most likely in March. That's a good thing. It's representing that the economy is strong enough on its own not to need the extra support, and the economy and the labor market is getting better. And finally, how are we positioned? Equity portfolios continue to emphasize, companies that are cheaper, a little bit smaller, and a little bit more higher quality than the overall market in general. And we think that those characteristics continue to do well in tough markets like we saw in January, but also position us well for the next tomorrow.
Thank you, Mark. Great update. If you have any questions or would like to discuss any of the topics we've covered in our webinar updates, please feel free to reach out to Mark or your advisor. And thanks for your trust in Wescott.